Hey, welcome to the show, everybody. As always, it's Capital Interactive with Besim and the Boz. We have a good show today, don't you think, Besim? We're going to talk about lines of credit.
Amazing show.
Yeah, line of credit it's a good topic. I think it's something that most businesses, it's one of the more common asks and requirements for a business, obviously depending on the business that you have. But a line of credit, it's very important for a lot of different reasons. And so we're going to kind of go into the ideology of what is a line of credit and everything that goes into securing it, what it's used for, and so on and so forth. So why don't you give Besim, everybody, a real high level of what is a line of credit, very high level.
Sure. Yeah. Well, a line of credit basically is an amount of money that the bank sets aside that you can use in your business to help fund your working capital cycle. So basically what that means is the bank is going to give you some money that you can borrow on and pay down through the course of a period of time and use to fund your working capital cycle. And so kind of what is a working capital cycle? Because, that's the term that we throw around, but a lot of times people aren't really clear on that. Why don't you give them real quickly what the working capital
So
cycle.
A working capital cycle for any business that, is producing product, service, or otherwise, and there's billing, there's a lot of things that go into it. So the working capital cycle is, let's say you produce a product, you produce a widget. So to do that, you need to purchase raw goods, inventory, and so on and so forth to produce a product or distribute it. You then sell it to a client base or clientele. That clientele receives the product, and then an AR, an accounts receivable, is created. And then there's a lag time between all the time that it took to get inventory, create a product, sell it to a client, create a receivable to then be paid sometime down the line. Obviously, terms vary for different businesses, different clients. So that is, and then eventually you will collect on that receivable. You'll be replenished with the cash to then start that entire cycle all over again. What a lot of clients and businesses want is they want a line of credit to help shorten that working capital cycle, or at least help redeploy and inject capital to start the cycle all over again. And it's not always the case where you can do that with internal funds. You use a line of credit to kind of bridge that gap from creation of product in the very beginning to collection of an account receivable for that good.
Yeah. So let me just give like a real basic example. Like, let's say I'm making pens, and it cost me $50 to make a package of these pens, and I sell them for $100. Well, from when I pay that $50 to get my inventory, and then I sell it to Adam, that $50 becomes my working capital. Now I give Adam the pens, and I give him the bill, and 2 weeks later he sends me a check for $100. Well, that $50 that it cost me to invest in the business to buy the pens and sell them to him, and then that time period that I got to cover, before I actually get the money back from Adam, that's my working capital. So a real basic example, but that's basically kind of what working capital is. And it might be different depending on the industry. Maybe that's really manpower. Maybe that's something else. It's not actually inventory, but that's what working capital is. And so people want to get financing for that because sometimes they feel like the more money they can put out and invest in their business, then they can generate more revenue.
Yeah, because if you have to wait for me to pay you the $100 so that you can start your working capital cycle all over again, it really decreases the amount of profitability and sales and so on and so forth that you can get. Because let's assume you had $50 to invest in working capital to create pens, sell them, and then collect on them. Well, if all you have is $50, the line of credit could be the injection for you to start a new cycle while you're waiting to be paid.
Exactly.
So that's generally what a line of credit is used for, to inject so you can keep creating working capital cycles while you're waiting for funds to come in.
Which is great. So let's just pause on that point for a second and talk about how lines of credit should be used. Because especially in the lower space, once a line of credit are issued, a lot of times there's not a lot of oversight on how they're being used. And so you see smaller business owners get into some trouble when they start buying, for example, long-term assets on the line of credit.
Right.
So talk to us a little bit about how the line of credit should be used.
Yeah, that's a good point, because a line of credit is a short-term facility, and it's meant to facilitate short-term needs like funding a working capital cycle. So A lot of banks, it differs for the size of the line in the bank, but generally on some of the smaller size lines, you'll see oftentimes a line of credit kind of sit fully drawn for an extended period of time. That's what we call either evergreen, or it's also called permanent working capital, where you've drawn it for a use and you haven't paid it down. That's called evergreen. What you want to see, especially with the larger lines, is it going up and down. So a draw on the line to fund working capital. The premise, though, is if you use this to fund working capital, as receivables come in, that money that comes in is used then to pay down the line of credit, so you can start it all over again.
Exactly.
But to Besim's point earlier, sometimes you will have businesses that don't necessarily use a line of credit strictly for working capital, and they're making hard asset purchases with the line of credit. Not that you can't do that, but the whole point and premise of a line is to revolve. That's why we call them revolving lines of credit. They go up, receivables come in, you pay the line down, and then you draw again to start that cycle all over again.
Yeah, and it's really interesting because actually whenever we're looking at lines of credit, renewals, things like that, we actually look at how much has the line gone
Right.
up and down. Has it actually hit zero at any point? Has it rested for a little while at zero when money's coming in, or is there a tranche that's always
Full drawn
and
to
that's
a point.
yeah, well, that's called like long-term working capital. It's basically there. It's what you have to invest in the business, and as you're growing, that's going to grow a little bit too. But and the thought from the bank is that's not really that portion of the line of credit, or that portion of the working capital really shouldn't be financed by a line.
Right. And a lot of times you will see a bank potential. Let's say you have a $500,000 line of credit. The lowest it's ever gotten is 250, right? So half. Then the bank will say, well, 250,000 was permanent working capital,
Yeah.
and 250,000 is truly revolving credit. So oftentimes a bank may term out that permanent working capital and say, well, this wasn't a line of credit, this was a term loan basically, and we'll term out that portion and then allow you to have the delta as the revolving line.
Yep. Well, let's talk a little bit about tenor of a line of credit. How long are these line of credits good for?
It differs. It varies. They're, like I said earlier, they're short-term facilities, so generally they're short in tenor, as opposed to a building that can go 20 years, 25 years, because that's a long amortizing asset. Generally, lines are short, 1 to 2 years. You'll see a few that might go past a few years, but like 1 to 2 years, one being extraordinarily common because it's a short-term facility and it's also being backed by short-term collateral. We'll get to that in a second, but generally they're going to be short, and that's because the bank wants that kind of annual purview of what's going on with usage. And any type of lender is going to want to touch it on a regular basis just to see how it's performing relative to the assets backing it up. That's why we keep those as shorter term facilities. You generally won't see it go much longer unless there's an extenuating circumstance. I've seen lines that are cash secured. So, so long as it's cash secured, you'll get a longer term.
So another place I see longer lines of credit is when companies are smaller and the lines of credit are small, and they're tied to the person's personal credit as well. So when I worked on much smaller companies, like I would see a lot of evergreen lines, which is basically like they're just going to be automatic. They're just green forever, basically like a credit card. They're just going to go out like there. And so, that's when a lot of people don't have the oversight, because banks it costs them money to relook at a loan.
Yeah.
And so if it's a small dollar amount, they don't want to do that every year. But you're right. I think 1 year is typically the most common. But one question I have a lot of times when I see people coming from those small lines where they're used to it all the time and they want to get a larger loan, and they see that, hey, when you present them a term sheet and it says, okay, this is a $3 million line of credit, and now it renews every year annually, they get scared a little bit because they're concerned that at the end of that 1 year, they're not going to have access to that capital anymore.
Right.
So can you talk just really kind of what the intent is at the year end, basically renewal, and how likely is it that they won't get line renewed, basically.
Yeah, well, I mean, it depends on how it's been handled, you know.
Yeah.
So the bank, like I said earlier, they're going to want to look at this every year to make sure the assets still justify a line of that size, and then also the usage. Some banks don't care if it's evergreen because to them it's just this perennial, you know, revenue stream. We're going to be getting interest on this every month, every year, whatever the case may be. But it is also it's a signal to the bank. It's a risk. It's a risk pulse check. If you have a line and it's fully drawn and it's evergreen, it really can signal sometimes. Do you have an inability to pay on this line? So is there some sort of cash crunch, or is there some issue that you won't be able to pay on it? So a bank wants to look at it every year, not only from the asset side of the house, but just is it signaling some distress at the company level where you can't satisfy your debt obligations should you need to. So that's why we're going to have those on shorter tenors, so we can just always stay ahead of what is needed and any potential pitfalls with the company.
Yeah. I would say for the most part, banks intend on renewing lines of credit unless there's businesses that deteriorate or something like that. But for the most part, banks don't really want to take that line of credit away. They just want to be able to review it at least of an annual basis. And so I wouldn't get scared if I was a new borrower and see that annual renewal basically is in there. Just know that they want to be able to look at information.
Right. And keep in mind, like, having it reviewed every year can work to your benefit. I mean, Besim and I have seen a number of situations where we look at a line of credit and the company is growing, they're getting bigger. We might not only need to renew it annually, but we might need to renew it and bump it up annually.
Yeah.
We've seen that, and to the other side too. We've seen companies with lines that are well in excess of what they need. We're going to renew it, but we might renew it at a smaller amount because you simply just don't need access to a line that size. But yeah, I think it's less of the bank doesn't want to renew it annually. I think 9 times out of 10 we do renew a line, but we also want to right size it because the size of the line relative to the company is important.
Okay, so as we've talked about in other podcasts, banks look at two things primarily whenever they're looking at loans. What's the primary source of repayment, which is typically cash flow,
Right.
and the second thing is collateral. So cash flow, we got that. That's revenue you're generating in your business, and that'll go to repay the line of credit. Talk to us a little bit about how banks collateralize these types of loans. And then maybe get into how they find out what's the right size of the loan for the company.
Right. So with a line of credit that is, it can vacillate, obviously, because it's being tied. So it's a short-term facility. It's going to be secured by all the short-term assets that are appropriate. Primarily and most generally, it's accounts receivable. You can have a combination of things: accounts receivable, inventory, equipment, but generally it's a receivable because that is the lifeblood of the repayment to the line of credit. Is you're going to collect receivables, you can use those receivables to pay down the line. So we'll start with receivables. Receivables, it starts with an eligibility. So a bank generally will not want to take receivables that are aged past 90 days. Why is that? Depending on your terms and what terms you have with your clients to extend receivables and have them pay you back. Once a receivable goes past 90 days, the likelihood of fully collecting on that at times is diminished greatly in some instances. So a bank, first of all, will take all the receivables that are eligible. So non-foreign receivables, because we'll have a hard time perfecting on foreign receivables. We'll take anything that's 90 days or shorter and look at that at a base. And then we will take what's called an advance rate on that. So we'll take, let's say you have 1 million of eligible receivables, 80% of that would be 800,000. So we'll start with that. Why do we take an advance rate on receivables?
Well, I mean, the main reason there's a couple of different reasons that we take an advance rate on receivables. One of them is, if you think about it, if I'm creating a receivable to Adam for those pens, I'm creating a receivable of $100, but he only needed $50 to generate that receivable. So for one thing, you don't necessarily need all the money on the AR in order to pay for your working capital cycle. Does that make sense? Mm-hmm. So basically, I only needed another $50. I didn't need to get my $50 back in order to generate another pen sale of $100. So I didn't really need the full $100, even though that's what the AR is. Second of all, if there's any kind of deterioration in the AR, if there's an issue with the AR, the bank wants that 20% buffer that if they had to write off a portion of the AR,
Right.
it's still there. Or if the company goes bad and we have to, try to collect on the accounts receivable.
You're never going to collect on 100%
Yeah, you're not
of
going
them.
to collect
So
on 100%.
the bank builds in that kind of risk factor.
Yeah.
Also, you think of it in a way of it's kind of like the bank's holding cost of, well, now because we're not going to collect on the receivables, we'll probably, hire that out to some sort
Sure.
of third party. So there's a cost to
Sure.
that, almost like the bank would do some sort of factoring of receivables to be able to collect. So that's why obviously they're advanced and they're discounted in that respect.
So let's talk about a few of the other things that might make a receivable ineligible or make it more difficult to add towards eligibility. Another thing I've seen is government receivables.
Government, yes.
A lot of times those are difficult to include in eligible receivables because they're hard to perfect liens on. Like receivables from individuals, for example, like those are difficult. So I see that, for example, in law firms where maybe an individual is paying a lawyer for a lawsuit, that makes it more difficult. If there's concentrations of receivables.
Yeah.
So let's say you're doing business with ExxonMobil and Shell, and those companies represent 80% of your AR. The bank is going to be concerned about that.
Right, for a number of different reasons.
Yeah.
Nonetheless, least of which is when you have such a large concentration, and a general bogey for a bank to really start to put more optics on this is when there's a concentration above 20%. So if 1/5 of your receivables is to one company, that's risky because while it's good that you have a good base, even from a very good receivable base client like an Exxon, Amazon, whatever, and I believe we said this in another podcast, if they go away tomorrow, and not that the company goes away, but they decide to do business or different
Somewhere
vendor
else,
that cuts the price in half, is the business doesn't have to go away. They just need to go away from you, which will impact you, severely. So we like to see also a very diverse receivable base where you don't have all your eggs in one basket, because that can be, somewhat of a scary situation for a bank in collecting on those receivables. And along those lines of eligibility and quality of receivables, which is why the bank will never take, let's take contractors, for example. A lot of them have progress billing receivables where they're going to bill in tranches as work is completed. A bank is not going to take that as an eligible receivable because if you're a contractor and you're doing work for a specific client and you're 40% of the way done with the job, another 60% to collect, something goes sideways with the job, the bank is never going to be able to collect on a job for a client where the work is 40% done.
Yeah.
I wouldn't pay the rest for a job that wasn't completed, right? So that also kind of goes to the eligibility of what we see from a receiver.
And there are some ways to make some of these things eligible that some banks, for example, like if it's a foreign receivable and you buy, insurance on it or something like that, that might make it eligible. But we're just speaking in generalities here.
Right.
And so now you've got this. So you've narrowed down your pool of eligible receivables, and it's $1 million, for example. The bank generally, you said, will give 80%, and so that means that they'll put they'll give you 800,000 of that $1 million of eligible receivables towards a working capital line. There's a second part of sometimes a third part of the collateral as well. Talk a little bit about how we would look at inventory, for example.
Yeah, inventory, that will go in lockstep with receivables. Now, it doesn't get the scrutiny as an AR does, but there are still general rules as it pertains to inventory. For instance, let's say you have $1 million worth of inventory. Well, generally, the advance on that would be about 50%. So if you have $1 million of inventory, we would look at, roughly 500,000 as being, backing the line of credit that we would advance on. Asterisk or, caveat with that is it depends on the type of inventory. A bank will generally take anything that's in raw good status, so something that's more commodity and can be, has some sort of transferable value, or finished goods and products. What a bank won't take is anything that's a work in progress. We called it WIP, WIP. Take, for instance, Besim's pen example. He's, making these pens. We're not going to take a pen that's halfway through production. It doesn't have the cap on it, doesn't have the clicker yet in it. So that's why a bank will, when it comes to inventory, will take something that's either pure raw good or finished, nothing in the middle that's kind of in transit. And then the 50% advance rate again, to kind of the receivable base is, we're not inventory resell. Like a bank doesn't know how to resell pens, so it will have to go out to market at some sort of discount, which is why inventory is limited to generally, and I say generally because there's extenuating circumstances, but we'll take 50% of that. That being said, we will not take inventory in excess of what a receivable position would be.
Yeah.
So speak to that, because generally we
Yeah.
cap
So
that.
in this example that we had, if you had $500,000 of eligible inventory, so you had $1 million of inventory, we cut it by 500,000. But let's say your accounts receivable were only 400,000. Well, the bank's going to say we do not want this line of credit to be dependent more on inventory than on accounts receivable. So we're only going to give you 400,000 for the accounts receivable, but then we're going to give you 400,000 for the AR, even though margined. So the inventory 400,000 for the inventory, even though the inventory margined is 500,000, they will cap it based on what your AR margined eligible receivables are.
Right. And that's because the AR is really the primary source of
Yeah.
collateral. Inventory is additive, and it certainly helps. But really, when you look at a line of credit, ARs are the repayment source, not the inventory, not the half-finished pen or the raw goods of the pen. Yes, we can do that. But ARs are really ultimately what comes in to pay down the line.
Okay. So before we get into like how we value all this, let's talk about the third tranche that is kind of less used, which is equipment, and talk about why we would look at equipment, and then how that goes into factoring into the line.
Yeah, I mean, equipment is the third of the three tranches for collateral on a line. AR, inventory being 1 and 2. Equipment will basically go in there as a third buffer, and that's generally when you see an all asset lien. So in ABA, an all business asset lien, equipment is eligible. Again, some caveats with equipment. It would have generally the same 50% advance that you're going to get on equipment. But with equipment, it's all free and clear equipment. So if you have equipment on the balance sheet, but it is also pledged or liened, so you have copiers, but you have either a capital lease or something on the copiers, that would not be in an all business asset lien, or at least that the copier portion of the equipment wouldn't, because a bank would be in a junior position collecting on the copier and so on and so forth. So we will take equipment, but again, it's going to have a much lower advance rate, 50% generally speaking, and that will satisfy if we want to take what's called a blanket lien on all the assets, the receivables, the inventory, and the equipment.
So that explains to us a little bit how the equipment is figured in there and why we might use it. Generally, it's not. But, we've got all of these things here. And people sometimes just have company prepared statements and they think, I can write AR, whatever I want. Tell us about how the bank verifies some of this information that you're providing when they're sizing their line.
Right.
And like how often they do it, things like that.
So when a bank looks at the asset position, yes, we'll use the balance sheet and we'll take the details that are on the balance sheet, but a supplementary form just for starters would be what we call an AR aging, an account receivable aging report, that will break out in much more detail than you find on a balance sheet, but it will break out the entire client base that has a receivable out to them in what their current position is, their 30 to 60 aged portion, their 60 to 90, 90 plus, and so on and so forth. So a bank will use that to really get a much deeper dive into the eligibility of the accounts receivable. And then as you start to go up in complexity and size of line, a bank will also do something that's called a field audit to really go out and verify, because you can put anything you want on a balance sheet, to your point earlier, but it will be verified in some instances. For instances like a borrowing base, we'll go out there and do a field audit. Besim, why don't you tell people, what does a field audit all entail in terms of eligibility?
So on a field audit, basically the bank is asking a third party to go out there and verify the process by which you're generating your AR. So they're going to actually dig in and look at your records and look at how you're getting to the numbers that are on your AR aging and on your balance sheet. So they're going to say, like, when are you creating a sale? When are you generating the AR? when are you closing that out? What does 30 days on your AR aging mean? What does 90 days mean? Because sometimes people will say it's current, but that really means it's under 30
What's
days.
current? Yeah.
Yeah.
Is current just a few days? Is current 30 days? It varies.
Yeah. And so
greatly.
when we have larger lines of credit, now they don't even have to be that large. I'm talking $1 million line of credit sometimes.
Yeah.
At least initially, the bank's going to go in and they're going to audit your practice and see how are you actually generating this AR, because they want to make sure that you're doing it in a responsible way, and that they make sure that they understand what you're putting on your piece of paper there and what that means. Because I've seen, like I just said, a really common one is people say current, and that means that it could be 30 days, and that means current. Well, and then they'll say 30 to, and then they'll say like 30 days, and that really means 60 days. And then they'll say, so bank wants to make sure that everyone's on the same page, that we understand what we're talking about, that we understand what we're getting into. And so they'll send a third party out there, and then the third party will talk about the practices, who they're billing, and just kind of make sure that everybody knows what the AR is and what it means and how it's being generated. Likewise, a lot of times on the inventory, not as much, but also on the equipment, it's possible to have appraisals. Like if you're using equipment, they'll send out an appraisal an appraiser out there to look at the equipment and see what kind of condition it is, how it's being tracked and managed, all that type of stuff.
Condition and then value, right? Because there's orderly liquidation value and fair market value. The bank will take a valuation on pretty much the more conservative number at times.
Yeah,
but
exactly.
You'll get more of a valuation and a true number of equipment.
So I mean, just so people understand, like the bank is going to do its homework, especially on larger deals, to make sure that they understand exactly what they're getting into, and then they're going to go from there. So that's kind of how they verify this stuff. We talked about kind of how we're looking at sizing the line. Let's talk about how, what a borrowing base is.
Right.
Because as you get to larger deals, you're going to have a borrowing base, and then talk about a little bit how often they're looked at, just generalities
and that
about
varies, but a borrowing base. So we talked earlier on, a line being renewed annually on some of the lower end. Once a year we're going to touch it just to see, what the collateral looks like relative to the line as the line being used. But when you go to a borrowing base, which facilitates much larger lines, the requirement, so starting with the field audit to kind of verify the assets and the number of assets that we have, a borrowing base can be somewhat regular. We've seen it quarterly borrowing bases, semi-annual, monthly, and it's a re-attestation of this is the amount of assets we have in certain tranches, in certain buckets, and it gets verified, or you have to reattest at certain points in time, because that will then dictate and potentially vary your line availability. We've seen borrowing bases, for $10 million, but the 2 months from now, we're going to do a borrowing base certificate where you attest to X, Y, or Z. That $10 million line drops to 8. Until you submit a new borrowing base to maybe kick it back up to 9 or 10 or so on and so forth to revalidate.
Yeah, so there's a difference between what a bank sets aside for you, which is and what's available. Yeah, exactly. And then they're going to look at it on a lot of times it's a monthly basis.
Yeah.
It depends on
common.
the company and how the AR works. But I've got clients, for example, where they've got a large line of credit, and they'll send in a monthly borrowing base. And like you said, let's say they had a $10 million line of credit. Well, the bank's going to make us basically do that calculation. They said, we're gonna commit $10 million to this line of credit, but every month you're only going to be able to borrow based on what your collateral base is. And so we're going to say, okay, let's say, how much AR do you have? Okay, well, we have $10 million in AR. Okay, that's eligible. Now we're going to trim it back down to 80%. So that's $8 million. And what's your inventory? Oh, we only got $2 million of inventory, but we're only going to give you half of that. So it's only $1 million. So in that particular month, you can only do the 8 plus the 1, which would be 9. Even though your line of credit says it's 10 million.
10 max.
You really only have availability of 9.
Right.
And then we're going to see what's outstanding on the line. Let's say you've already borrowed 5. Well, then you only have an additional 4 left to borrow on. And most of the time, this is done either on a monthly or quarterly basis.
Right.
It's not really done on an annual basis unless you have a multi-year type of facility. But even then, it's typically done, I'd say, on a monthly or quarterly basis.
And that's in the title of what it is. It's a borrowing base. So your base is $10 10 in this example,
Yeah.
but you monthly need to, attest to what your limit is. And we've also seen it, I know I have, where we have a borrowing base, again, let's use 10, 8 is outstanding and the borrowing base comes in and the line should only be 7.5 million. Well, you gotta come back to the line and
Yeah, you got to pay it down.
yeah, pay down to 7.5 just to be fully capped for that month until you justify with the new borrowing base that you can borrow back up to the limit.
Yeah, and that helps banks kind of keep the line within the collateral, make sure that the secondary source of repayment is there. But those are things that you got to understand as you're getting larger. You have to understand that you need to be paying it down as you're collecting on your accounts receivable, because once it gets funded up, if your AR inventory, things like that drop, you can be in a position where you'll have to come to the table with a lot of capital.
Absolutely. All right, so that covers a lot of the basic mechanics. We're talking about collateral, but let's also go into just one final territory with lines of credit, and that is something that is maybe less receivable heavy and inventory and equipment heavy, because now we're in what we call ABL, or asset-based lending territory from a line of credit. So what does that look like?
So basically, as we talked about multiple times, the bank looks at, they want a primary source of repayment and a secondary source of repayment. Most of the time we're looking at cash flow as the primary source of repayment. But in some instances, some lenders are willing to look at collateral as the primary source of repayment. So in those situations, most of those are called asset-based lenders. They're looking at what the assets are and then giving you an advance at that. So they'll basically do that borrowing-based calculation that we talked about, and that's going to be the primary factor for approving you of the line.
Right. Keep in mind, they're not agnostic to cash flow. Cash flow still has to be sufficient, but it's not the primary driver.
Exactly.
It's more collateral based.
It's more the collateral base. It's more about what your ARR is, and they like that more than inventory, just like we talked about before. But you can be marginally profitable and still get a line through an ABL lender because they're looking more at the collateral than they are at your profitability.
And why is that? Is it because they're more astute with working off of collateral should something happen and they need to kind of collect and work with the actual collateral?
Yeah, they are. So a lot of times, well, first of all, it's gonna be more intrusive on you from a day-to-day basis because they're looking at your collateral as the primary source of repayment. They're gonna want more information on that collateral on probably even a weekly basis. And sometimes they'll even set up different type of banking structures where they can take control of funds coming into your account to make sure you pay down the line, things like that. They're also taking more risk, so a lot of times it'll be more expensive. There are situations where ABL is actually cheaper, but if we're the kind that we're talking about, it'd be more expensive. And then they are more used to selling off receivables, collecting on receivables, things like that.
Now, a lot of that's not that it is negative. It has sounds like more of a negative tint, but the pro of it though as well to that point is ABL lines can be very sizable.
Yeah,
they can be be massive lines because, like I said, they're going to be digging into the collateral base on a much more regular basis. But the pro to it is you can definitely get some good capital injection with a very large ABL line.
Yeah, there's a lot more to cover when it comes to this, and we'll actually do a podcast where we take a borrowing base and go through it and look through an AR aging and kind of explain how we do the calculations, because there's some nuance to it. How we trim back the concentration. When do we disqualify somebody because they have a portion of their AR that's over 90 days, things like that.
Yeah, cross aging.
Yeah, different stuff like that. Yeah. So we'll actually go through on a separate podcast and talk through all those things. But this just gives you a high level overview of how banks are looking at lines of credit, what they're used for, and that type of thing.
Yeah, absolutely. Besim, any parting thoughts or words of wisdom for the viewers in the ether out there?
No, I would just say, when you're doing the borrowing base, when you're doing the lines of credit, keep in mind this is for short-term working capital. I've seen a lot of times where people get burned because they've got this portion of their line of credit that they use to buy equipment. They used to buy. I had one client a long time ago that bought an $800,000 ERP system, which wasn't even a tangible asset.
Yeah.
And so they wanted to refinance it. They had no room on their line of credit because they had used it to buy this ERP system, and we couldn't even refinance the equipment because it wasn't a tangible asset, really. So just be cautious and cognizant of that as you're using the line of credit. Don't get over your skis on it, but know that these guardrails that the banks put in place are kind of it's for the bank's protection, but it also kind of protects you as well. But that's really it. I mean, like I said, we'll dig into some of the other details in more detail in another podcast, but thank you guys for watching, and we hope you're finding some value in these type of things.
Absolutely. If you find some value, hit that like button, subscribe. We're coming out with new content on a regular basis. Appreciate you listening today. It was good conversation about lines of credit. If there's anything that you want in addition, leave a comment. We can bring it up certainly in another podcast. Appreciate the time today. As always, Capital Interactive with Besim Tafilaj, and we'll catch you on the other one.